This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now we're going to look at some financial risks. And the first two on this list we cover very quickly. Dealing with credit risk is pretty straightforward, pretty well known. Before you extend credit to a new customer, you do some investigation, like looking at the financial statements, doing a credit reference search to see if they seem to be good credit risk. Then you will establish a credit limit, and then you'll keep an eye on them for a while, and the credit control department will make sure they're paying on time. If they don't pay on time, then you may remove the credit facility or reduce it. Political risks, the risk that either if you're dealing with a country it doesn't pay you, or a particular organization in a country is maybe unable to pay you because of a law which forbids money to be transferred. If the country does take this sort of a reaction, not much you can do about it. I think here what you want to do really to avoid a lot of political risk is to have a really good look at the stability of the country and its type of trading and its type of leadership before you decide to embark on any sort of financial transactions either with the government there or with companies in that country. We spend most of this chapter looking at currency risks, where you having to translate, say, dollars into your own currency, and interest rate risks, where the interest rate may increase after you take out the loan, and you're going to be left paying a lot more interest. So let's look at foreign currency risks, and there are three sorts of foreign currency risks: economic, translation, and transaction. So economic risk, the exchange rate fluctuations affect the competitiveness of imports and exports here. So if a currency gets stronger, then when it's selling its goods in the foreign market, it will cost more in the foreign currency, and therefore you will lose competitiveness against home produced products in that country. Similarly, if a currency gets stronger, imports become cheaper. So if I'm importing something from America into the UK, and let's say the current exchange rate between, let's say, the dollar and the pound, let's say it's $1.5 per pound, and the American cost is $300, then $300 translated into pounds, 300 divided by 1.5 would be £200. But if the dollar weakens, or if you like, sterling strengthens, and the exchange rate is $2 per pound, then that 300 coming in is only going to cost you 150. So there's been an apparent price drop from £200 to 150. Note that this can adversely affect companies in the UK, even if they are not importing or exporting. They're simply competing with someone who has imported. Really, the only defense you have here is to try to diversify and not simply deal with one country and therefore be at the mercy of one currency. So if you're exporting goods, export some to America, some to Europe, where you'd be looking at a euro rate, maybe some to Australia, where you're looking at the Australian dollar rate, and you hope they don't all go up and down together, and you get a little bit of alleviation through simple spreading the risk. But there's no other real way of dealing with that. Translation risk comes when you have a group and it has to translate its foreign subsidiaries' balance sheets and so on for consolidation. They're going to be translated at the closing rate, and so basically it looks as though the value of this subsidiary is kind of going up and down depending on what the exchange rate happens to be. It's got no real cash flow effects. It's not completely, immensely important, but nobody likes to see the value of the group decreasing and so on. The best way to deal with it really is to reduce your exposure to this foreign currency by using loans in the foreign currency to finance those assets. So if we had a US company, a big one, a US subsidiary, and it's going to be in dollars. It's going to have some assets in here, let's say of 200,000. Well, let's make 200 million there. What we'll do is we'll take out maybe a long-term loan, let's say 170 million in dollars, so that really the net amount to which you're exposed is only $30 million, a much less dangerous or much less eventful kind of amount that's going to alter much less, if you like, if the dollar rate changes. I'd often also say that it makes sense to do this because these US assets here will presumably produce dollar income. And your liabilities here is going to, of course, require interest in dollars. So you have a nice match going on there. You create income in dollars and you're paying for your interest. You're paying your interest in dollars. It doesn't really matter what the exchange rate does. If you would finance this not by a US dollar loan but by a UK loan, you would be getting a dollar income and having to translate that into UK pounds and use that to pay the UK interest. But if essentially the dollar weakened when this dollar income was reduced, there mightn't be enough to pay the UK interest. So it's going to be reducing risk both on a kind of asset liability basis, going to be reducing risk on both an asset liability basis and also reducing risk on a kind of income expenditure basis if you substantially fund the assets with matching currency liabilities. Some terminology here. An exchange rate. An exchange rate is the rate that you change your money at, basically. And the spot rate, this is the rate you get today if you went to the bank. The forward rate is a rate which is promised and guaranteed for the future. So you can go to your bank and say, I'm coming along with a month's worth of, in a month's time, with some pound sterling. I want to translate it into dollars. What rate will you promise me? So this can give certainty. Rates are quoted in a couple of different ways. So here, this one here is meaning, if I go in with $1, this is pesos per dollar. So I go in with $1, I'm going to get 12.9 pesos. And CIMA quite often has a slightly different way of doing it. It's this one here, which nearly looks the reverse of that one. This is pesos per dollar. This looks like dollars per peso. But the key here is to see this one. This is saying $1 is going to give you 12.9 pesos. So those two ways of telling you the exchange rate amount to exactly the same. A bank, as you know from going on holidays, will always quote you two rates, and you will know by now which rate they give you. The bank will always give you the rate which leaves you worse off. And this is really all the knowledge you need to know which rate to use in any particular circumstances. Choose the one, irrespective of how it's written, which is going to leave you worse off. So here it's written 1.2022 to this one here. It could be written the other way around. Sometimes you'll often see it written the other way around. Say 1.2088, 28 rather, to 1.2022. I wouldn't worry about the way around it's written here. This here is telling us if you go in with £1, this is telling you how many dollars you're going to get. So let's leave this one, let's get that one, get rid of that one up there. So what that spot rate is telling you is if you go in with £1, you're going to get a certain number of euros in here, not dollars. So you go in waiving your £100, whatever it's going to be. The bank will either multiply that number of pounds by 1.222 or 1.228, and it's going to give you the lowest amount of euros it can. So this will be from pounds to euros, and as soon as you've got one of them sorted out, the other one, whichever way round it's written, is going to be the reverse. Okay? Banks give you the rate which leaves you worst off. And I always write above these rates because it's deadly to a question if you get it the wrong way round, and it's very easy in the heat of the moment to get it the wrong way around. I always write these little arrows above. Once one's sorted out, the other one's automatically sorted out. I don't need to go through the process again, really, as to which one of these two rates I have to apply. So here's a little example. Well, we need to sell we need to sell pounds to buy $1,000. How many pounds is that going to cost us? Well, let's look at this. This is saying the number of euros you get per pound. So I went in with £1. The bank's going to give me the lower one here. So this is going to be pounds to euros. So this here is going to be euros to pounds. What am I doing? I am selling euros to buy, I'm selling pounds here to buy euros, so I'm going to be interested in this one. That is the rate which is going to be applied. So if we know that £1 is going to be equivalent in this exchange here to 1.2022, we have to say, well, if we had €1,000, we have to end up with €1,000. How many pounds is that going to be? I think you can see that it is going to be in here. It's going to be 1,000 divided by 1.2022. So 1,000 divided by 1.2022 is going to be about £831. 0.81. So if you like, €1 is worth 1 over 1.2022. €1,000 is 1,000 over 1.2022. And then look at the logic of it, maybe even do it backwards again. If I went in with 831.81 pounds, and this is the number of euros I was getting for it, so times 1.2022, yeah, comes out spot on 1,000. So that's how you decide which rates to use and so on. You'll find that many texts deal with buys and sells and offers. My advice, I mean, if you're happy with that, maybe you've been working with foreign currencies a lot and you're all over buys and offers and sells and so on. My advice would be to kind of avoid that sort of terminology. It's easier simply to work out which rate is the bank going to use. It's going to use the rate which gives you the lower rate. Right above the rates, the direction of the change that's going to be applied to, and you're kind of home and dry. So let's look at these lecture examples. And they've been chosen really to get you away from currencies that you might be familiar with, to make your work a little bit harder. So the first one, you're an Australian exporter, you need to put your hands on €30,000. You'll be changing US, you'll be getting €30,000 from your overseas sale. You have to change that €30,000 into your home currency of dollars. The second one, you're a US importer, and we have to find 500,000 rupees to pay our supplier. And we want to know, in both cases, how much of your home currency is going to be basically affected. So let's look at the first one here. An Australian exporter, we're going to be getting €30,000. So let's see which rate is going to be applying to us in here. And the way the rate's given to us there means if you went along with €1 Australian, the bank will either give you €6.833 or will give you €6.843. It'll give you the lower amount if you went along with your €1 Australian, So this must be the dollars to euros. It's only going to give you 6833 euros, not 6843. So once we've got that one sorted out, the other one is automatic. Which one are we doing? Well, we have 30,000 euros. This is going to be the relevant one here. Okay. So we're going to be on that 6843. Some people will be able to see this kind of pretty well immediately here. The decision really now is, do we multiply or do we divide by 0.6843 there? And again, it's so crucial to get the right way around. Essentially what we're saying here, and remember you can ignore this now, it's not part of the question anymore. This is really saying that €1 is equivalent to or is equal to, this is saying, get it the right way around, this is saying that $1 Australian is equal to 0.6833 euro. Or if you want to write it, divide through in here, 1 over 0.6833 Australian dollars is equal to €1. We know we have 30,000 euros, so what we would do is to say, therefore, 30,000 euros is going to be times 1 over 0.6833 dollars. So we're going to be coming out with about $43,840. 30,000 euros will translate into that. The second example, we are a US importer. We have to get our hands on some Indian rupees. Now what the rate is telling us here, if you went in with $1, waving it to the bank manager will either give you 60.1853 rupees or 60.2354 rupees, and the bank manager will give you the lower of that for your dollar. So this is it here. What are we doing? We are taking dollars and having to change them into rupees. We need to get our hands on 500,000 rupees. So that's the relevant one there. Okay. So basically what this is saying is $1 is equivalent to or equal to 60.1853 Indian rupees. We can turn it around. We're saying 1 over 60.1853 dollars is equal to 1 Indian rupee. Therefore, 500,000 Indian rupees would be simply 500,000 divided by 60.1853. So kind of two places to trip up. You choose the wrong rate, and then you multiply rather than divide by the exchange rate, and it's absolutely fatal if you do either of them wrong, and it's just worth taking your time if you're prone to making errors. Even after years of doing this, I found it very easy to pick up the wrong exchange rate. I found it even very easy to multiply rather than divide by the rate if I'm in a bit of a rush. I always try and take my time on that. Now, before we get on to looking at ways, this is just kind of be exercising ourselves on to how to use exchange rates. We'll look at some factors that may influence exchange rates. Now, in practice, exchange rates are influenced by all sorts of things. They're influenced kind of randomly by political events and economic events and so on. We can't really cope with that. We're looking at more stable sort of factors that might be around. And we'll come back to cross rate in a moment. But we'll look here at forecasting some exchange rates, and there are really three types of, two to deal with exchange rates really, and then a third type of little connection as well that we need to look at. And the first little theory here is interest rate parity. An interest rate parity is what it's forecasting is the forward rate. So interest rate parity is forecasting a forward rate. What it is essentially saying is if you've got two different interest rates here, a clever and cunning person could borrow money and pay the lower interest rate, translate that money into the foreign currency and invest at a higher interest rate and make money essentially by doing nothing. So we could take someone in the UK. So what we're going to do is we would borrow, let's say 1,000, and the current exchange rate, we're going to get $1,500 for that. So this is sterling, this is in dollars, going to be 1,500. So the current exchange rate is 1.5. After a year, we're going to have 1020 in there. So adding on 2% in there, and after a year here, we're going to have a plus 5%. So 1,500, 1575. Now I'm only going to be sure of making money if I don't lose money because the dollar is going to be weakening in some way. If the dollar went down to $2 to the pound, then I'm going to be really kind of disappointed because this 1575 divided by 2 is simply not going to pay off my overdraft here. And the only way I can really guarantee of not making a loss on this is to say, well, I want a forward rate, a rate promised in the future that will enable me to translate back here. And so 1587 divided by 1020, well, that's 1544. That is the predicted forward rate, or the forecast forward rate. And it is such that people cannot make money by this kind of financial engineering. It should be impossible simply by borrowing in one currency and investing in another currency and doing nothing. It should be impossible to make money because everyone will be doing it. And we can't all make money by doing nothing. Only a lucky few of us can. So this gives you the forward rate after a year. If we did it for another year, there'd be another plus 2% and another plus 5%. We can predict what it's going to be then. So 1020 plus times 1.02. The overdraft will go up to about 1040.4. And the amount on deposit, 1575 times 1.05. It's coming in there at 1653.75. The forecast or predicted forward rate in 2 years' time is that divided by 1040, it's about 1.59. Now you will come across formulas which do this for you, but I don't think it's worth learning them. I think just do a little example like this, and you'll come out correctly and reliably with the forecast forward rates. The second one is purchasing power parity. And purchasing power parity is predicting not the forward rate, but the future spot rate. Essentially it says that what gives money its value is what you can buy with it. Okay. So here we've got the current exchange rates between the pound and euro 1.4. So what we're saying here is in pounds and in euros. If we had £1,000 pounds, this is going to be equivalent to 1,400 euros now. The exchange rate is 1.4 euros per pound. And we're saying this is going to buy an article. So we have an article sitting in the shop here, and we can either buy it with £1,000 or 1,400 euros. But because we can buy the same article with either £1,000 or 1,400 euros, £1,000 must be worth the same as 1,400 euros. It's your purchasing power. Same purchasing power as purchasing power parity. Now what's going to happen in a year's time? And both of these are going to be subject to inflation. In the UK it's 3%, and here it's going to be 7%. So in the UK this article, whatever it is going to be costing 1,030. Same article, it's just its price is inflated. And in Europe, inflation, the price tag go up there by 7%. It's going to be 1,498. But these amounts of currency are both going to buy the same thing. So we're saying that these must be worth the same. We're saying that these are equivalent to each other. They're on a par. So divided by 1,030 there, the exchange rate is 1.45. In other words, essentially the euro has weakened. You think of inflation as a kind of erosion or wearing out of the currency. So we've gone down from 1.4 euros per pound to 1.45 euros per pound. The euro is worth less than it was. And that's because the euro is kind of wearing out here at 7%, whereas sterling is only kind of wearing out at 3%. And you could do it for another year, inflate again, and so on, whatever number of years are required. Finally, we have what's called the international Fisher effect. And the international Fisher effect is really to do with interest rates, but it kind of ties the other two together. We need to know about it a little bit. It says that really in the whole world there is only one real rate of interest. So this is unique. And what makes interest rates different in different countries is the inflation rate. Okay. So let's say in the UK, and this is not nowadays, but let's say in the UK, the bank rate or the bank interest rate is quoted at 7%. This is what the bank says is you're going to earn, and this is a nominal rate. Okay, this is like the headline rate is 7%. But this 7%, first of all, there has to be within it the idea of keeping up with inflation. Even if you're not richer, you need to keep up with inflation. And then on top of that, you actually want to be slightly wealthier because you've invested your money for a year. So let's say the inflation rate in the UK is 3%. So what we're saying is 1 plus 0.07 is equal to 1 plus the real rate times 1 plus the inflation rate. So 1 plus the real rate is 1.07 divided by 1.03. So 1.07 divided by 1.03, it's about 1.03 89, nearly 4%, but not quite. So in other words, the real rate here is equal to 0.0389 or 3.89%. And the theory says that everywhere in the world the real rate will be 3.89%, but then the rate you're actually quoted in that country will be that adjusted by inflation. So if you went to a country where, let's say, the inflation rate was 9%, then the bank has to pay you enough to keep you up with inflation. That's an extra 9% just to stand still with regard to your consumption powers. Plus it then has to give you this 3.89% to make you really better off. So in this country we have saying 1 plus the nominal rate is going to be 1 plus the real rate times 1 plus the inflation rate, 1.09. So here we have that times 1.09. It's coming out at about 1.1323. So that's 1 plus the nominal rate. Therefore the nominal rate is 0.1323 or 13.23%. Much higher bank rate in this country with a lot of inflation, to keep up with inflation. Now just go back a couple of slides because we went over something called the cross rate. And the cross rate allows you to really construct or potentially construct an exchange rate from two other exchange rates. And it works. You can do it in the newspapers, you can look it up, make sure it works, and so on. Just check the answers, so to speak. So what we're going to do is we're going to use these two rates really to predict that rate. Okay. So these were quotes from the paper, and we'll just make sure they're going to be working. So let's write out what this really means here. So £1 gives us $1.42. Now I like to write this round this way. This is saying dollars over pounds equals 1.42. Okay. In other words, we're saying that one pound is going to give you $1.42. Okay. The second one here, this is really saying that euros per pound is equal to 1.29 euros per pound. Okay. What we want to be getting essentially here is we want to be getting euros per dollar. We want to get a dollar-euro exchange rate. Now how can we get that from the figures above here? Well, it's going to be, if we take this one here, it's going to be, or one way you can get it is euros per pound times pounds over dollars. So these two pounds are going to cancel out. You're going to be left with euros over dollars. So in terms of what we've got here, euros over pounds is 1.29. Pounds over dollars is going to be 1 over that. We don't want dollars per pound, we want pounds per dollars, so you turn it all upside down. So we should be coming out in here 1.29 divided by 1.42 at 0.91. So the newspaper was obviously correct.